If you're a homeowner past the age of 60, pause everything you're doing because starting in 2026, the IRS is implementing a quietly announced change that could end up costing you thousands of dollars. And the vast majority of older homeowners have no clue it's on the horizon. I'm talking about your house, your nest egg, and the stability of your retirement. Here's what isn't being discussed on the nightly news. This upcoming IRS change is aimed squarely at homeowners. And if you don't take the correct actions before the deadline arrives, you could find yourself cutting a check to the government that you never should have owed. I can almost hear your response. I've had my house for ages. I've always followed the law. There's no way this applies to me. That is exactly what many seniors believed right up until they were blindsided. Whether you're thinking about selling, handing the property down to your children, or simply staying put and enjoying a quiet retirement, this rule shifts the landscape. The bright side is there are completely legitimate strategies to shield yourself, but only if you move quickly and understand what steps to take. In this video, I'm going to explain in plain language what this new IRS rule really means for you, who is most exposed, and the 3 straightforward actions you can start on today to safeguard your home and your savings. Before we dig in, if you know another senior homeowner who needs this information, hit that like button right now so YouTube shows this to the people who need it most. Let's look out for each other. Now that you understand what's potentially on the line, let's get into the specifics. Because knowing how this IRS rule works is not just helpful, it is absolutely essential for your long-term financial health. And I want you to grasp every part of it so that when this video is over, you feel calm, educated, and ready to move forward. We'll begin at the foundation. For many years, U.S. homeowners, especially older Americans who have held on to their homes for a long time, have benefited from something known as the home sale exclusion. This is a section of the tax law that lets you keep a large portion of the profit from selling your main residence completely free from federal income tax. If you file as a single taxpayer, you can exclude up to $250,000 in profit. If you are married filing jointly, that figure rises to $500,000. This rule has been in place for a long time, and countless seniors have counted on it when selling their properties to move into retirement communities, downsize, or relocate nearer to loved ones. Now here's where it starts to get tricky. In 2026, the IRS, together with new legislative instructions that became effective this year, has rolled out revised guidance on how that exclusion is calculated, who is eligible, and under what circumstances it might be reduced or even removed entirely. And it's not limited to people who sell. It has ripple effects for seniors planning to leave their home to children or grandchildren, for those who have rented part of the home, for anyone who has used a room as a home office, and even for people with reverse mortgages. In short, this touches nearly every homeowner over 60 in the United States in some fashion. Let me walk you through the biggest shifts, starting with the requirement about living in the home. Under the prior rules, you had to have used the property as your main residence for at least 2 of the 5 years before the sale to qualify for the exclusion. That sounds straightforward, right? You live there, then you sell, and you don't have to pay tax on the first $250,000 or $500,000 of your gain. But the new IRS interpretation tightens what qualifies as a true primary residence and how that time period is documented. Here's how that plays out in real life. If you've spent substantial stretches of time, maybe several months each year, at a vacation property, a second house, or staying with relatives in another state, the IRS may now take a closer look at whether the home you claim as your primary residence genuinely qualifies. They're reviewing factors such as where your mail is delivered, the state where you're registered to vote, where your cars are registered, where you see your doctors, and what your utility and credit card records show about where you actually spend most of your days. For seniors who split time between warmer and cooler climates, snowbirds who winter in places like Florida or Arizona and summer in the Midwest or Northeast, this is a particularly important caution. If the IRS decides that your main residence is really the winter property instead of the home you plan to sell, you might lose the exclusion entirely. Let's move to the second big change, which hits a large group of seniors who may not realize they're affected. If you've ever rented out a segment of your house, even casually, even just one bedroom on Airbnb or a similar site, or even to a relative or friend who gave you a modest payment, The IRS has now made it explicit that any part of the property used to generate rental income must reduce your exclusion on a proportional basis. This concept isn't completely new, but starting in 2026, enforcement is much tougher and some thresholds have been adjusted. What does that look like in dollar terms? Suppose your home is now worth $400,000 more than what you originally paid. That sounds fantastic. For most seniors, that increase represents decades of diligence, sacrifice, and wise decisions. But if 20% of your property has been rented out for any portion of the last 5 years, then up to $80,000 of that profit could now be exposed to capital gains tax, even if you're under the general exclusion caps. And depending on your total retirement income, your capital gains bracket might be 0%, 15%, or 20%. Add in the 3.8% net investment income tax, which can hit higher income retirees, and you could face a tax bill of $10,000, $15,000, or even $20,000 or more on a sale you assumed would be entirely tax-free. I want that figure to really register because this isn't some theoretical scenario. It's happening to real seniors all over the country who will sit down with their CPA or tax preparer this year and realize that the sale they counted on, the one meant to pay for the next phase of their retirement, is going to produce a much larger tax liability than they ever imagined. Let's continue, because the third update affects a narrower group of seniors, but is also one of the most misunderstood aspects of this new framework. If you've been dedicating a portion of your house as a home office, a space you actually claimed as a deduction for business on your returns, the IRS has long required you to pay back or recapture the depreciation you took on that part of the property when you sell. That's not new. What changed in 2026 is the formula used to calculate that recapture and the tax rate applied to it, which has increased for many people. Where it once had a maximum rate of 25%, the new guidance in some cases subjects that recaptured amount to ordinary income tax rates, which can be significantly higher depending on your total retirement income. I know we're getting into more advanced territory here, and I want to pause to say this clearly. You do not have to memorize the details. You do not need to transform yourself into a tax professional. What matters is that you recognize these changes exist, that they probably touch your situation in some way, and that the wise move, the only realistic move, is to sit down with a qualified tax expert or elder law attorney before making major housing decisions. I cannot emphasize this strongly enough. Spending a couple of hours with a knowledgeable professional could save you tens of thousands of dollars. We'll discuss how to find the right kind of help a bit later in this video. But first, I want to address the question many of you may be asking. What if I'm not going to sell? What if I simply want to stay put, grow older in my own home, and then pass it on to my kids or grandkids? Do these changes still matter? The unfortunate answer is yes. And in some cases, the consequences for inherited property are even more critical than the rules for a direct sale. Here's why. Under long-established tax rules, when your home passes to your heirs, they receive what's known as a stepped-up basis. That means instead of inheriting your original purchase price as their cost basis, they inherit the current fair market value as of the date of your death. So if you paid $80,000 for the property and it's worth $600,000 when you die, your heirs' basis becomes $600,000, not $80,000. If they sell soon after inheriting, they may owe little or no capital gains tax because the sale price is close to that new basis. That stepped-up basis has been one of the most powerful ways for families to transfer wealth and has especially helped seniors whose homes have grown greatly in value over the decades. But the new 2026 framework adds restrictions and new reporting duties around that stepped-up basis that you and your heirs must understand. Estate and gift tax thresholds have been altered. The interactions between certain trusts, gifting strategies, and basis rules have changed, and the IRS is paying far closer attention to property transfers among relatives that occur near the end of life or that appear primarily designed to sidestep taxes. This does not mean that planning around your home in your estate is no longer possible. Quite the opposite. It makes thoughtful estate planning more crucial than ever. But it does mean that some tactics people once used, like casually adding a child's name to the deed, making informal family transfers, or relying on unwritten agreements, may now trigger tax outcomes no one intended and no one desired. Let me give you a concrete scenario that shows how real this can be. Picture a grandmother in her late 70s who has lived in the same house she purchased 40 years ago. The property's value has soared. Her adult daughter helps care for her, and everyone assumes the daughter will end up with the house. A well-meaning acquaintance suggests that the grandmother simply put her daughter on the deed right now to keep things simple. Under the new IRS rules, that kind of change in ownership can be treated as a partial gift, which triggers gift tax paperwork, may cut down on the daughter's right to a full stepped-up basis later, and in some cases can cause immediate capital gains issues. What felt like a straightforward, loving decision can become an expensive error, not because anyone was careless, but because the rules changed and they weren't informed. That's the central message I want you to carry from this video. The rules changed and very few seniors or homeowners have been told. You're not going to hear this at your card game, your worship group, or your neighborhood potluck. The people who understand these changes are tax lawyers, accountants, and financial planners. And unless you actively seek this knowledge, it's very easy to make a completely innocent choice that ends up costing you or your loved ones substantial money. Now let's shift to what you should actually be doing, because my goal is not to frighten you, it's to equip you. And there are real concrete steps you can begin today to protect yourself. Step 1 is to gather your paperwork. Locate your original home purchase records, your closing statement, settlement documents, or any paperwork from the time you acquired the property. If you've made major upgrades over the years, like a new roof, a room addition, a remodeled kitchen, or updated plumbing or electrical systems, pull together those invoices and receipts as well, because they increase your cost basis and lower your taxable gains when you sell. Many seniors don't realize that every dollar they've invested in improving their home is a dollar that reduces what the IRS sees as profit. Step 2 is to honestly review how the property has been used. Have you ever rented out a bedroom? Have you run a business from home? Have you claimed a home office deduction? Has a caregiver lived with you and paid any form of rent? Have you posted the property on any short-term rental websites, even just once in a while? All of these details matter, and your tax advisor needs a full picture to guide you correctly. Third, if there's a loan on the property, including a reverse mortgage, you must understand how that debt interacts with any sale or transfer. Reverse mortgages in particular come with special rules about what happens when the homeowner moves out, sells, or passes away. And the 2026 changes have created new timing and reporting expectations for both owners and heirs. If you have a reverse mortgage and haven't talked recently with your loan servicer or a HUD-approved housing counselor, you should set up that discussion soon. Fourth, and I know I've repeated this, but it's vital, make an appointment with a real expert. Not a casual friend who helps a few people with taxes, not a basic tax chain that mostly processes simple returns, and not even the nice neighbor who's done your taxes for years but doesn't specialize in real estate or elder law. You want a specialist who understands how the 2026 IRS changes affect home ownership, estate planning, and retirement income. You're looking for a CPA who frequently works with retirees, an elder law attorney, or ideally both collaborating. If the cost worries you, and I know that for many people living on fixed incomes, paying professional rates can feel impossible, there are options. Many communities have low-income taxpayer clinics that provide free or low-cost help. ARP operates a tax aid program that connects seniors with trained volunteers. Your area agency on aging is often able to direct you to free or affordable legal and financial services where you live. The National Council on Aging offers a benefits checkup tool to help you find programs you may be eligible for. Fifth, if you already have a financial planner or estate attorney and they have not brought up the 2026 IRS changes in your recent meetings, you need to initiate that topic yourself. Ask directly, how do these new rules affect my house, my estate documents, and my overall tax picture? A competent advisor will be glad you asked. If they seem unclear or unfamiliar with what you're describing, that in itself tells you something important. Now I want to spend a moment on something that goes beyond spreadsheets and tax forms, and that is the emotional side of all this. Your home is not just a line item on a balance sheet. For many of you watching, it's the place where you raised your children, hosted holidays, and created decades of memories. It's where you feel safe. The idea that a government agency might influence what happens to that home, how much money you receive from it, or whether your kids can inherit without a heavy tax bill can feel deeply personal and even upsetting. And that reaction is completely understandable. But here's the reality. The government is not actively trying to seize your house. These are tax regulations. And like all tax regulations, there are ways to work within them. People navigate them every day with the right assistance. The seniors who are most at risk from these changes are not the ones watching videos like this and seeking advice. It's those who don't know the rules have changed, who make choices in the dark, or who assume things will work just like they always did. Right now, information is your strongest shield, and that's exactly what you're gaining by sticking with this video. I also want to touch on an issue that comes up constantly with older homeowners, and that's timing as it relates to capital gains tax rates. Many people are aware that long-term capital gains tax is linked to your total income. If your income is low enough during retirement, you might actually qualify for a 0% capital gains rate. That sounds terrific, and for some seniors, it truly can be. But that's where planning becomes crucial. When you sell a house and receive a large lump sum of gain, that income is counted in the year you receive it. Suddenly, your income for that year can spike, potentially bumping you out of the 0% bracket, raising your Medicare costs through the income-related monthly adjustment amount, and possibly increasing the portion of your Social Security benefits that is taxable. All of these systems are connected, and a choice about your house can send shockwaves into areas you never anticipated. A good tax planner will examine your entire financial landscape, not just the home sale by itself. They'll consider tools like installment sales, charitable strategies, and carefully chosen timing to reduce your total tax costs across multiple years. These are strategies real retirees use every day, and they're available to you if you reach out to the right professionals. I also want to say something to those of you who are married or partnered. If you own the property together, with both names on the deed, then your decisions about the home's future must account for both situations. What if one of you dies before the home is sold? How does that affect the stepped-up basis? What choices do you have regarding how the title is structured? Joint tenancy, tenancy in common, community property in states that allow it? These are not just theoretical legal phrases. They are choices that can influence your tax bill by tens of thousands of dollars and should be part of your conversation with a qualified advisor. And for those whose grown children help manage the property, maybe they've chipped in on the mortgage, paid for repairs, or handled the place while you travel or receive care, be aware that these arrangements can carry unintended tax and legal consequences under the new rules. Even the most well-intentioned family financial setups should be reviewed in light of what changed in 2026. There's one last topic I want to cover before we finish, and that's the question of timing more generally. One of the biggest mistakes people make, not just with home sales, but with any financial planning, is waiting too long. It's natural. Change feels hard. Taxes feel complicated. It's easy to say, I'll sort this out later. But with the 2026 IRS changes, later can become very expensive. Think about the cost of delay in this context. Suppose you intend to sell next spring, and you assume the old rules still apply. Because you never sat down with a professional before listing, you failed to gather proof of your home improvements. You didn't realize that the spare room you put on Airbnb 2 years back would shrink your exclusion. And you had no idea that the way your title is structured increases your tax burden. By the time your accountant uncovers all this, the sale has closed and your tax situation is already locked in. That kind of story plays out all the time across the country, and it is 100% avoidable. Prevention almost always costs less than trying to fix problems after the fact when it comes to taxes. And even if you're not preparing to sell anytime soon, the estate planning side of these changes means that every year you postpone updating your documents is another year of vulnerability. Wills and trusts drawn up 5 or 10 years ago may not reflect the new landscape. Beneficiary choices that were sensible before might no longer be ideal. For many seniors, the home is the single largest asset in the estate, and it deserves the most careful, current planning you can give it. I open this video by telling you that this situation is urgent. I hope by now you clearly see why and why I feel such a strong responsibility to help seniors across the country become aware of these shifts. Not so you feel anxious, but so you feel empowered and ready. You worked a lifetime for your home. You bought it, you paid it down, you took care of it, and you created memories there. You deserve to have it serve you and your family in the best way possible. These new IRS rules don't have to be a disaster. With solid information and good advice, they can be managed. But you have to take that first step. So here's your action list after this video. First, gather your purchase paperwork and improvement records. Every roof replacement, every remodel, every capital upgrade you've made increases your basis and shrinks your taxable gain. Second, write down any ways you've used the property for something other than your primary residence in the last 5 years. Third, set up a meeting with a qualified CPA or elder law attorney this week if you can, not sometime down the road. Fourth, if you have a reverse mortgage or any complicated title structure, call your servicer or attorney today, not after the holidays or after the summer, today. And fifth, open up a conversation with your family. Make sure your spouse, your children, and anyone who will be involved with the home later understands the stakes and is included in the planning. Family meetings about money and inheritance can feel uncomfortable, but the families who have them are the ones who are shielded and prepared. I want to genuinely thank you for sticking with this video from start to finish. I know this was a lot to absorb and some of it was dense and detailed, but you showed up, paid attention, and stayed with it. That alone puts you ahead of millions of seniors in this country who don't yet know the rules have changed. Share this video with a friend, a neighbor, a sibling, or any retiree you know who owns a home and is over 60, because this information is far too important to keep to yourself. And if this video gave you clarity, if it offered something practical, something that made you feel more prepared and less uncertain, I'm asking you to do one simple thing. Click that like button, leave a comment telling me your single biggest insight, and subscribe so you never miss another important update like this. Your financial stability matters. Your home matters. The legacy you leave for your loved ones matters.